Michael Harris is founder of Cribstone Strategic Macro and joins us now. Michael, great to have you back with us on the program here. Just picking up off Steve's comment about the performance we've seen in US markets. It has been strong up to this point, but the last month we seem to have run into a little bit of treacle. What do you think the second half of the year brings in terms of risk on?
Well, the U.S. markets can't run into treacle; they can run into molasses. But I think the quote you just gave in terms of that stat on never losing money, well, that incorporated the potential that you could lose those double-digit gains as well from the first half. So I wouldn't read too much into that. Now the debate is about nothing but inflation, right? Is it transitory, or is there an element that this is going to become more permanent? I think at this stage, when we still don't know how many people, for instance, in the UK have lost their jobs, and we don't know how many people are going to, get jobs in the US, there is an element where it's a little bit premature because we're not worried about we're worried about inflation becoming embedded. We're not worried about repricing and readjustments, because there's a big difference between a one-off move in prices, which is just sucking up some of this excess that's been pushed through to help us through this crisis, versus embedded inflation expectations. I'm super disappointed in policymakers because they basically are just giving opinion, and you're not hearing discussions of where is all this excess money supply going? Is it going into assets, or is it going into things that cause inflation? Or is it going into elements, let's say financial markets, where effectively, if they correct, they can be deflationary at a certain stage? So I think we need a little more coaching from the central banks in terms of where they see the risks and what they're looking at. Housing, for instance, which is going nuts everywhere because it's a search for yield play. People have all this excess money. The mortgage rates are as low as they are. Housing arguably has a longer-term impact on inflationary expectations because it drives rents. This is, people need to live somewhere. So I think the central bank teams are effectively being remarkably lazy when it comes to analysis of inflation, and just saying it's transitory without actually justifying it. And at the same time, those that are saying it's like an Andy Haldane who are saying we worry about it, they're not also justifying why they think it's going to be stickier longer term. I've had the displeasure of working on the Turkish market, where everyone gets excited about interest rates as the driver of inflation. But in Turkey, they raise interest rates. Everyone loves the new central bank governor a little while back. And then Erdogan slips through a 22% increase in the minimum wage. So I think this is important, Stephen. It's all about wages. And in Turkey, they raised wages 22%. And the market ignored it because they were only looking at interest rates. So we really need to look at wage expectations over time. And in the UK right now, we have all these people on furlough that are going to be off furlough soon because companies are going to have to start paying their national insurance.
Michael?
And so we're going to learn actually now a little bit more about unemployment. And once we figure that out, if we have a tight labor market where inflation expectations start to bleed through, we've got a problem. For the time being, it seems a little early. So I'm pretty relaxed, actually.